Hello everyone, my name is Angelina Mancarella and my topic is the Health Savings Account deduction. Today I am going to go over a brief history of health savings accounts, and also known as an HSA, to provide you with some general understanding of how they work. Then I will discuss the initial purpose of the HSA deduction when it was enacted into the Internal Revenue Code. Three metrics will be used to measure and analyze the results of the enactment of HSAs. These metrics will then determine if the purpose was met, and finally, some recommendations for further legislation for HSAs will be made. HSAs were enacted into the Internal Revenue Code by the Medicare Prescription Drug Improvement and Modernization Act of 2003. It is covered under Code Section 223. Before HSAs were enacted, medical savings accounts, or MSAs, were the predecessor. These accounts were similar to the now HSAs, but HSAs are much more accessible and were made permanent. The history of MSAs is covered in my paper, but for this presentation, I will not touch upon it as there is much to cover on HSAs. Health savings accounts are available to individuals who participate in high deductible health plans. These are also known as HDHPs. Contributions can be made to these health savings accounts. The contributions are then excluded from income and employment taxes. There are certain limitations on the maximum amount of contributions that can be made to your HSA. For the 2018 tax year, that limit was $3,450 for a self plan and $6,900 for a family plan. Individuals over 55 years old are allowed to contribute an additional $1,000 for the 2018 tax year. Individuals over 65 years old whom are eligible for Medicare are no longer allowed to make contributions to their HSA. However, any unused balance by these individuals can still be used for qualifying medical expenses. Distributions from HSAs are not includable in gross income when they are made for qualifying medical expenses. The earnings inside the HSAs are also not includable in gross income. But if the distributions are made for non-qualified expenses, they will become includable in gross income and subject to an additional tax of 10%. The main requirement to participate in an HSA is to be enrolled in a high deductible health plan. While you must be enrolled in an HDHP to participate in an HSA, you are not required to participate in an HSA just because you are enrolled in the HDHP. It is optional. As defined under Section 223, for a plan to qualify as an HDHP plan, it has to have an annual deductible no lower than $1,000 for a self plan and $2,000 for a family plan. Also, the plan has to have an annual deductible and out-of-pocket expenses not to exceed $5,000 for an individual and $10,000 for a family. Let's discuss the reason why the HSA deduction was enacted into the Internal Revenue Code in 2003 and the purpose behind it. The original purpose of the HSA was to give the ability for taxpayers to have tax-favored treatment for current medical expenses, and also to allow them the ability to save on a tax-favored basis for future medical expenses. The driver behind this was the increase in the cost of medical care and insurance. From the year 2000 to 2006, health insurance premiums alone grew by approximately 86%. Three metrics were analyzed in order to determine if the original purpose of the enactment of HSAs was successful. The metrics used, which I will discuss in great length, were HSA deductions taken on individual tax returns, the enrollment in HDHP plans, which have been analyzed with and without HSA accounts, and contribution and balance trends of HSAs. To successfully determine that the original purpose of the health savings accounts has been met, we will need to see positive results in all three of these metrics. The first metric is the HSA deduction on individual tax returns. We will look at who is benefiting from the HSA deduction, how many people are benefiting from the HSA deduction, and the trend in the number of deductions claimed on tax returns. To be successful in proving the purpose of the HSA deduction was met, then the findings should show that the people are claiming the HSA deduction on their individual tax return, that there is a large number of people benefiting from the deduction, and lastly, that there is an upward trend in the number of tax returns filed with the deduction claimed. I compiled this table from raw data that was sourced directly from the IRS historical tables from 1999 to 2016. Since the first tax year that the deduction was available was 2004, that is where the table begins. The table shows the number of returns filed with an HSA deduction claimed by year. As you can see, approximately 91,000 people claimed the deduction on their personal tax return in 2004. Then in 2010, over 1 million people claimed the deduction. This is an increase of approximately 914,000 or 1,000%. Each year over the first 5 years saw an increase of at least 100,000 to 200,000 tax returns per year. Then from 2010 to 2016, the increase was over 700,000 tax returns, again with each year increasing. While the number of tax returns filed with an above-the-line HSA deduction shows a positive increase over time, we also need to take a look at those benefiting from an HSA who do not claim the deduction on their tax return. Since employees are able to contribute pre-tax dollars to their HSA, they can be contributing and benefiting from this type of plan without claiming the deduction on their tax return, since they are already receiving the pre-tax contributions. Those who take the deduction on their return are contributing post-tax dollars outside of their W-2 and therefore receiving the deduction when they file the tax return. Highlighted in yellow, you will see that this table shows the tax value of deductions claimed on tax returns by the number of families in thousands and the amount of deduction in millions. It also shows the tax value of exclusions, which would be those contributing through their employer with their pre-tax contributions. While the table is a snapshot of the 2014 tax year, it shows that approximately 1.4 million families claimed the deduction on their tax return in 2014, but another 6.9 million families benefited from the exclusion of their contributions of their pre-tax dollars. For the second metric, with enrollment in HD-HP plans, it is important to analyze if people are taking advantage of these type of plans and also the impact income and education level may have on the enrollment in these plans. To successfully prove the intent of the HSA deduction, these findings should be that people have increasingly participated in these type of plans. This chart from the U.S. Department of Health and Human Services illustrates that from 2007 to 2017, enrollment in HD-HP plans with the Health Savings Account for individuals 18 to 64 years old with employment-based coverage increased from 4.2% to 18.9%. This is an increase of 14.7%. Enrollment without an HSA increased from 10.6% to 24.5%, an increase of 13.9%. While this shows an increase for both plans with and without an HSA, the increase is slightly stronger for those plans with an HSA. Meanwhile, enrollment in traditional plans decreased from 85.1% in 2007 to 56.6% in 2017. Adults ages 30 to 44 had a greater enrollment in HD-HP plans with an HSA than those aged 18 to 29 or 45 to 64. HD-HPs with an HSA also increased as income increased, from 7.9% among income of 138% federal poverty level to 22% among those whose income was greater than 400% of the poverty level. The higher the income level, the more likely they are to enroll in the HD-HP plan with an HSA and less likely to enroll in the traditional plan or HD-HP without an HSA. Enrollment with an HSA also increased with educational attainment, from 10.7 for those with less than a high school education to 23.9 for those with a bachelor's degree or higher. For the third metric, HSA contributions and balance trends were analyzed. To successfully prove the purpose of the HSA deduction, we should see favorable increases in contribution balances showing increased involvement and enrollment in these type of plans. From 2011 to 2017, combined individual and employer contributions increased from an average of 2,348 per family to 2,843. While this is less than half of the maximum family contribution allowed, the increase indicates that the larger contributions are being made over the years. The average distributions from HSAs during these same years was 1,725, which would imply that families were saving an average rollover of 1,119 towards future medical expenses. The year-end balances of HSA accounts that had been open since 2007 had an average balance of 8,384, while accounts opened in 2017 had an average year-end balance of 1,240. This shows that the average taxpayer with an HSA is making contributions beyond the current year's expenses and saving for future medical expenses. It is also estimated that there were 22.2 million HSAs at the end of 2017, 73% of which have been opened since 2014. This chart shows that the average HSA contributions also increased with adjusted gross income, which makes sense because those who may have more available funds might contribute more to their HSA. As you can see, those taxpayers with an AGI over $200,000 contributed the most. This table, which was shown earlier as well, shows the 2014 families with contributions to HSAs. As you can see, those taxpayers with an AGI of $75,000 to $100,000 had the second largest number of families contributing, while those with an AGI of $200,000 to $500,000 still had more total dollar contributions but made by a fewer number of families. Through the three metrics analyzed, it is clear that the original purpose of the HSA deduction, which was to provide the ability for tax-favored treatment for current medical expenses and to allow tax-favored savings for future medical expenses, has been successful. I think that the code has been successful because it is clear that there has been a significant amount of increase in the number of people both claiming the HSA deduction on their tax return and benefiting from the exclusion of their contributions from their W-2 when making pre-tax contributions to their plan through their employer. There has also been increasing enrollment in HD-HP plans with HSAs and a decrease in traditional plans, showing that people are taking advantage of these types of plans and benefiting from the tax-favored treatment. And lastly, the average contributions per family have increased as well as the average year-end balances, showing that people are continuing to contribute and enroll into HSA and HD-HP plans. In conclusion, I would recommend the expansion of health saving account plans. The success of these plans have been proven as all of the metrics analyzed showed positive results in fulfilling the purpose of enactment of the HSA into the Internal Revenue Code. My recommendation would be to increase the contribution limits to allow for more future savings for future medical expenses for those involved in an HD-HP plan. Also, I would recommend to expand the HSA to allow them with other types of plans, such as traditional health plans, but with lower contribution limits, so that those individuals with traditional plans and lower deductibles can also benefit from saving for medical expenses, but not to allow them to contribute nearly as much since their out-of-pocket expenses tend to be much lower than those individuals with HD-HP plans. Thank you for watching, and I look forward to your feedback.